If you've ever noticed that property investors seem to make serious money every year, but often pay far less tax than people who don't invest, you're not imagining it. And it's not because they're dodging the system. It's because they understand how the system is designed to work. In today's video, I want to walk you through why property is such a tax-effective play, how investors use it legally and strategically, and how this actually plays out over time in the real world. This is general information only, not personal tax advice. But if you understand these principles, you'll make far better decisions and avoid some very expensive mistakes. Let's start with the big picture. Property investors tend to outperform non-investors tax-wise for two core reasons: compound growth and leverage. Compound growth is the long-term increase in asset value driven primarily by supply and demand and inflation. It compounds year after year. Leverage is the ability to use a bank's money to control a much larger asset than you could with cash alone. And here's the key. The cost of that leverage, particularly interest, are tax deductible when the asset is used to produce income. So in the early years, an investor can hold an asset that grows in value over time while their operating losses reduce their taxable income today. That's what people loosely refer to as negative gearing. And eventually, as rents rise and debt reduces, that same asset can move into positive cash flow and give the investor real options and flexibility. I'm not explaining the theory here. I'm a case study that this works in practice. Ever notice how property investors can make money every year, but somehow pay less tax than people who don't invest? Here's the difference. One side, you've got a PAYG worker. They earn income and it gets taxed straight away. On the other side, you've got a property investor. Their money flows into an asset first. That asset's leveraged, the costs are deductible, and the growth of that asset compounds over time. So no, it's not loopholes, it's leverage, compounding, and structure. This property investment is the reason why I have built the financial freedom that I now enjoy today. Now that you understand why property behaves differently, let's ground this in fundamentals before we get more technical. Most people think investors buy property for cash flow. In reality, for most investors, cash flow comes later. Property is primarily about compounded capital growth over time. The leverage just happens to make it very tax effective during the accumulation phase. And this is why money sitting in a bank account usually falls behind. Let me give you a simple comparison over 1 year. $200,000 in a savings account at 4% earns about $8,000. The same money in an owner-occupied offset at 5.25% saves you about $10,500 tax-free. But if you put that money into shares at an 8% return, you might make $16,000. But if you use that $200,000 as a deposit to control an $800,000 property growing at 6%, and the asset will then grow at $48,000 over that year. Same starting capital, completely different outcome. That's the leverage effect. Now, once the property is owned, this is where confusion usually starts. So let's slow this down and talk about income, expenses, and how tax actually works. Rental income is not taxed in isolation. It's assessed along with the expenses of holding that property. Interest, rates, insurance, property management, repairs, depreciation all come off that rental income. Most investors understand the obvious expenses, but what many overlook is depreciation. Depreciation allows you to claim the wear and tear on the building and certain fixtures, even though it doesn't affect your real cash flow. That's powerful. You can have a property that's actually cash flow positive, but still negatively geared on paper. For example, $48,000 of rent, $35,000 of real expenses, $5,000 positive cash flow. But if you add in an $8,000 depreciation deduction, then on paper, that property is now showing a $3,000 loss. That loss reduces your taxable income. Most people think negative gearing means you're losing money, but that's not always true. You can have a property that makes $5,000 a year in real cash flow. That's money hitting your bank account. Then depreciation comes in. That's a paper expense. No cash leaves your pocket, but it reduces your taxable income. So on paper, that same property can show a $3,000 loss for tax. Same property, same rent, different tax outcome, because structure matters. This brings us to the most misunderstood concept in property: negative gearing. Negative gearing simply means the taxable position of that property is a loss. That loss reduces your taxable income for the year. It doesn't automatically mean that you're bleeding cash. In the early years, many properties are genuinely cash flow negative. $10,000, $20,000 a year isn't unusual. The idea isn't to lose money forever. The idea that the capital growth of the asset far outweighs the short-term cash flow loss, while a tax system softens the impact during the growth phase. As rents rise and debt reduces, that same property often becomes neutral or positive. This is why negative gearing exists. It incentivizes private investors to supply rental housing. Negative gearing was removed briefly in the late 80s. As a result, rents rose and it was quickly reinstated. Supply and demand still drive housing. Removing it today would actually worsen the problem. Now that you understand income, expenses, and losses, we need to talk about how profit is taxed when you sell, because this is where long-term strategy really matters. Capital gains tax is calculated at the sale price minus the cost base. The cost base includes things like the purchase price, stamp duty, acquisition costs, capital improvements, adjustments for depreciation, and if the property is held for more than 12 months, individuals and trusts may receive a 50% CGT discount. That discounted gain is then added to your taxable income in the tax year that you sell. This is why record keeping matters so much. If you don't track costs properly, you'll end up overpaying tax. The fastest way to trigger tax on a property is to sell it. When your property goes up in value, that gain is unrealized. You don't owe tax while you're holding it. But the moment you sell, that gain becomes real, and that's when capital gains tax kicks in. An alternative could be refinancing. You can access equity without selling and without triggering tax. Selling realizes gains, holding preserves them. Which brings us to something more experienced investors eventually realize. They don't sell. If you don't sell, you don't trigger CGT. Instead, investors often refinance. Provided serviceability exists, you can typically access equity up to 80% of a property's value. That equity release is not income, it's borrowed funds secured against the asset. So you can extract value, reinvest it, and continue compounding without triggering a tax event. Selling converts growth into taxable income. Refinancing converts growth into usable capital. That distinction changes everything. Now, naturally, this raises a concern people always ask. Does refinancing increase debt if equity is released? Yes, but investors do it because the return on that capital is expected to exceed the cost. And today's regulations show that banks assess loans with buffers for a reason. It's difficult to borrow yourself into trouble unless something genuinely adverse happens. Rising interest rates increase costs, but they often coincide with rising rents over time. The biggest risk isn't rates, it's an emotion. Media noise can cause people to sell good assets at the wrong time. Those who understand their numbers and have the right team tend to hold and adapt. More debt doesn't automatically mean more risk. Debt becomes risky when it's tied to those things that don't produce income. But when debt is used to buy income-producing assets, the risk profile changes. The real danger isn't leverage itself. It's poor structure, poor cash flow, and no buffer. But here's where people get caught out. Your main residence is generally exempt from CGT if it's only ever been used as your home. Once it becomes a rental, CGT can apply. The 6-year rule can allow exemptions if managed carefully, but this is where professional advice matters. Companies don't get CGT discounts, and trusts may. Owner-occupied rules don't apply to those entities. And if you rent rooms, renovate or convert use, the tax treatment can change. This is definitely not DIY territory. But here's the thing, you must track everything, keep everything, contracts, rates notices, insurance, loan statements, depreciation schedules. Store it all digitally, back it up, and work with an accountant who understands property. A good one pays for themselves many times over. Property investing is often called a finance game, and that's true, but the difference between an average investor and a great one is rarely one big decision. It's dozens of small ones done correctly over time. Before you sell, before you refinance, before you restructure, talk to your broker, talk to your accountant, These two roles are at the core of your team behind every successful investor. So, if you're thinking about investing, restructuring, or just want clarity on how this would actually work in your situation, there's a link below to book a call with my team. Otherwise, thanks for watching. If you want to keep deepening your property knowledge, feel free to hit like and subscribe so you don't miss future videos. If you've got any questions, drop them in the comments and I'll do my best to get back to you. Thanks again, and I'll see you in the next one.